Now let's continue with our discussion from where we left. Advanced financial reporting. You can see from the other side, there is a question that I want us to discuss from the other side because I think it would be prudent if we can take this discussion as we take some examples or illustrations. What we are taking today is impairment of assets. I will define what impairment is, and this is IAS 36. I will give you the meaning of impairment. I'll give you causes of impairment, both internal and external, and then I will show you how to calculate impairment of an asset. The last part of our discussion, which I will take a different illustration separately, will be to do with cash generating units. Meanwhile, we will take a discussion about the meaning of impairment and how to calculate impairment or accounting for impairment. This is one of the illustrations that I will take as this discussion goes on. Now, just as a summary of what we expect us to be doing, one thing that I want you to know is the present value interest factor, how to calculate it, not necessarily by using those tables which are mostly provided in financial management. So this column will be very important for you, and we calculate it by taking 1 plus rate raised to negative n. N is the time or the number of years. For example, in this first illustration here, I will be using my rate at 15%. So to get this column, I'll be taking 1 plus 15%, that is 15 over 100, and then I raise by 1 by n, that is, for the first year to get this, will be raised by 1. So second year, raised by 2, third year, raised by 3, or that way. And after that, I'll sum these numbers there, because I'll be multiplying this present value, interest factor, I'll multiply by these cash flows. You'll be given the cash flows of that particular asset. That is the expected cash flows that we expect this particular asset to generate. So if you are given these cash flows, then you have to establish the present value interest factors for that particular cash flow for each specific year. Then you multiply cash flows by the present value interest factors, and you get the present values. When you sum up these numbers all together, you get what we refer to as value in use. So value in use, after you get the value in use, then establish fair value or net realizable value. To get the net realizable value, you'll be taking the fair value minus selling cost. You get that particular number. Then carrying amount. We see carrying amount is the same as net book value, and it is calculated by taking the cost of the asset minus accumulated depreciation. So that when we are okay with the carrying amount, then after that, because as we will discuss in a while, we will be defining what impairment is. And impairment means those situations where the carrying amount is more than the recoverable amount. So this recoverable amount here, and how do we establish recoverable amount? We compare two things. One, value in use. You'll have calculated the value in use here. That is the total present value. The total present value gives you the value in use. So value in use, you compare with the fair value or the net realizable value. You take the higher. You take the higher. So that is very important thing there. That is very critical point. That is because we are saying that impairment means situations where the carrying amount is more than the recoverable amount. However, we must establish our recoverable amount by comparing two items. One, value in use, which means summation of these present values. You get the value in use. And then the net realizable value. Compare those two figures. The higher gives you the recoverable amounts. Therefore, for you to establish whether impairment has taken place, you compare the recoverable amount and the carrying amount. If the carrying amount is more than the recoverable amount, then that asset has been impaired, as we will discuss in a while. So, for example, here, I took all my cash flows, then I calculated present value interest factor, that is 1 plus 15% over n, negative n throughout. I got these present values, sum them together to get fair value or value in use, and then I compare with fair value minus selling cost. I compare these two, I take the higher, and then I compare with the carrying amount, which I will show you in a while. So I compare 7490. Remember here, my recoverable amount will be 638770 because you are taking the higher, compare with the carrying amount, this figure, you take the higher, and then you can see the carrying amount is more than the recoverable amount. Therefore, that asset has been impaired. So just a while, we discuss that, but what I'm saying is that in this discussion, we want to see what is impairment, how we calculate impairment, and how we account for impairment. So that is what I want us to do. And then from what you can see on this side, I've taken two examples for the purpose of illustration, illustrating impairment. The only difference is that for this first example, I have used interest rate of 15%. The other example, I have used interest rate of 10.5%. It's the same illustration. No difference, only that the rate is different. So I want to show you how do you establish whether an asset has been impaired. And again, I repeat that impairment occurs where carrying amount is more than recoverable amount. So in any situation, if you find you are given the carrying amount of an asset, and then you establish the recoverable amount, and then you realize that recoverable amount is less than, carrying amount is less than the recoverable amount, then that asset has not been impaired. Right, let me remind you because I told you that we'll be concluding chapter 1 of advanced financial reporting. Today is date 10 October 2025. Your examination is first week of December. Therefore, I request you to be part of us. Just subscribe to our YouTube so that anytime we upload a lesson, you are able to take advantage of that so that you don't get yourself in difficulties, or maybe you may not have enough time to complete your syllabus wherever you are. So I request you kindly for your own benefit to subscribe to our YouTube so that anytime we upload a lesson, you are able to take advantage of that. We move together because we say that before the end of this month, we should have completed this our studies or maybe the lessons, so that by next month, that is November, we should be revising. So just try to do that for your own benefit. So chapter 1 is about accounting for assets and liabilities, and we are winding up chapter 1. Leasing, we have done leasing, operating lease and finance lease, we completed that. Deferred tax with group aspects, we completed that. Employee benefits, share-based payments, we completed that. So we are taking impairment of assets, and that will be the major areas which are covered in chapter 1. Now, the other two things that we'll cover in chapter 1, which are just straightforward, is financial assets and financial liabilities, and then fair value measurement. So we are almost concluding on chapter 1. If you missed any class for chapter 1, then just go to YouTube and then you get those lessons there. If you need any assistance, I'll give you our numbers by the end of the discussion, and then you'll be able to communicate with us for any assistance. So once we are through with chapter 1, we move to group accounts, which is chapter 2. Very important, a major topic for the sake of the examinations. So make sure you subscribe so that when we move to chapter 2, we will be moving together. Maybe you were not part of us when we were starting chapter 1, but now you can just subscribe to be updated when we start chapter 2. Now let's move on, and for this illustration, I want us to use one of our books which we have written, because again we are also writers, we are authors, in other words, we are publishers. We publish management books, accounts books, all areas of accounts management, all that, because mostly we do a lot of research. So whatever we are doing here mostly is based on a lot of research. So you are with the right people. So trust us. Now I want us to do an illustration here using one of our books. So I will illustrate using one of our books to make our work easier. We have defined impairment of assets, and that is IAS 36. Impairment refers to the excess of the carrying amount of an asset or liability over its recoverable amount. That is the meaning of impairment. Comparing two items here, carrying amount, which is also known as net book value. And we know how to calculate net book value. You know how to calculate the carrying amount? Yes, it should be, because we say that carrying amount is given by cost of an asset minus accumulated depreciation. Once you get the carrying amount or the net book value, you compare with the recoverable amount. Important thing to know there are two things that you'll be comparing to establish the recoverable amount. Number one, value in use. Value in use, you calculate the present value of the cash flows which are being generated by that particular asset. And then you compare with net realizable value, as I've just mentioned here, and I'll repeat that once again. So we are saying that impairment refers to the excess of the carrying amount of an asset or liability. Need not necessarily be an asset, can as well be a liability. Impairment refers to the excess of the carrying amount of an asset or liability over its recoverable amount. The carrying amount is the value attributable to the asset for accounting purposes, i.e., the net book value. The recoverable amount is the value attributable to the use, that is value in use, or sale of the asset, i.e., net realizable value, whichever is higher. I've mentioned here, and we'll be coming back to our illustration. Now I want to show you an analysis of how impairment occurs. Because we are saying impairment, you have to compare two things. One, carrying amount and recoverable amount. When you come to recoverable amount, you have to establish the recoverable amount by looking at two items. One, value in use, which means present value of future cash flows, and then compare with net realizable value. You take the higher. That's what I'm saying. Now let me project that so that you can understand what I'm trying to say. So just look at, if you can see that diagram here, you can see here, see where my figure is, where impairment is. Try to look at that. Impairment occurs when net book value or carrying amount, you are comparing net book value with the recoverable amount. When you go to recoverable amount, you will not be provided with recoverable amount. You establish two figures. One, value in use and net realizable value. So that diagram there, or that diagram there is very, very important for us. Now, away from that, I think you have understood what I mean by that. The other point that I can read for you is that impairment loss is the excess of the carrying amount over the recoverable amount. That one we have discussed. Now, let me show you another diagram which also can help you to understand the concept of impairment. It's just like the previous one. You pick the one that you are comfortable with. You see where we have said number 5. You can also read the recoverable amount is the higher of number A, value in use of the asset. Number B, net realizable value. You take the higher. That is, to get recoverable amount, okay, let me show you from point 1 so that you may not ask what was in note number 1. Those are just notes that I have just discussed with you. Impairment loss is the excess of what and what. Number 2 is there. Number 3, then the recoverable amount occurs when. Look at number 5, and then there is that again diagram which I have shown you there. You can see carrying amount. You'll be taking carrying amount, which is the same as net book value, and then value in use. I've told you what value in use means. The present value of future cash flows. You'll be comparing with fair value minus cost to sell. Those two figures, you take the higher. So if you take the higher, compare with carrying amount. If the carrying amount, which is also known as net book value, is higher than the recoverable amount, then that asset has been impaired. So that is a point that I wanted to discuss with you. Now, once you have that, the other thing is knowing now there are internal and external sources of impairment. Now, I'll also show you some external sources and internal sources of impairment. Just let me present that one to you. Some external indicators of impairment. One is the carrying amount, but that one let me just present to you, because that was not my main focus, but because these notes you find them in our research materials, you can just take them for your own benefit. External sources of impairment. These are the external indications of impairment. So you have your 1, 2, 3, 4, 5. You can pause your video and you read them. Then internal sources are there. These are the internal indicators. 1 up to 7. 1 up to 7. So that is this one of our research materials or one of our published books that we use in our institution. If you need some of these books again, you can call us there, you can contact us there. You can see my number down there. The footnote, my number is there, Kimans Williams. So these are some internal sources and external sources of impairment. Now, having that in mind, let me take now my question. Let me take my calculations now, because that was my major concern. You have done all the theories in the other class, therefore. The purpose of this class was to present the calculations, because we have all our theories in our physical classes and also online classes. But if you are watching this from your YouTube, then you still have that part of the theories. Now let's take an example. Let's take an example together. ABC Limited owns a manufacturing plant with a carrying value of shillings 7,490,000. The government has just imposed export quotas on the products manufactured by the plant. The following this development, ABC Limited has prepared the following estimates of cash flows from the usage of the plant over the next 5 years. Now the years are there. Year 1 to 5, you are given cash flows 2300, year 2, 2110, year 3, 1570, year 4, 1040, year 5, 2330. Additional information. The plant could be sold currently for shillings 5.6 million. Selling costs would amount to shillings 100,000. Cost of capital is 15%. Present value factor. Now the present value factor, they have calculated for you at 15%. You see, at that 15%, if you take 1 plus 15% raised to negative 1, you get 0.8696. For year 2, if you take 1 plus 15% raised to negative 2, you get 0.7561. Now these are things you have done in FM. So I'll use 15% to illustrate example 1, and then example 2, I can use my rate at 10.5% required recoverable amount of the plant. Number 2, impairment loss, if any, on the plant. Round off your answer to the nearest a million. So that's my question there. That is our question. Now let's do it. Now that's quite simple. That is quite simple. For you, that's quite simple. Okay, it may be difficult because if you are taking it for the first time. But I'll make it as simple as I can, because my work is to simplify that which is difficult for you. Now, you are told ABC Limited, I've just presented the question there to you. So, but let me read again. ABC Limited owns a manufacturing plant with a carrying value of shillings 7,490,000. Carrying value means the net book value. Whenever you want to establish whether an asset has been impaired, you must have the net book value. Since impairment occurs when net book value, which is also called carrying amount, is more than the recoverable amount. And I've shown you how to calculate the recoverable amount. So ABC Limited owns a manufacturing plant with a carrying value of shillings 7,490,000. The government has just imposed export quotas on the products manufactured by the plant. Now, I have shown you some of the external sources of impairment and also some internal sources of impairment. Now, if the government has imposed export quotas, what does it mean? It means that we will not be using this machine to manufacture goods for export, and therefore, if that is the case, then that machine has been impaired. You can use it. Now, if I can give you an example about the plastic paper bags. Sometimes the year 2017 or 2018, somewhere there, I think the year 2018, the government introduced certain environmental laws which prohibited the manufacture of plastic papers. Now, there were so many companies in Kenya, around the industrial area in Nairobi, which were manufacturing these plastic papers. So because that law was introduced, which banned the use of plastic papers, then how were those machines of any use? Were those machines of any use to the investors? Obviously, no. They became impaired because they were meant for manufacturing plastic papers. And now the government has introduced a certain law which bans the use of plastic papers in the country. So where did those machines, how else could we have used those machines as investors? There was no way. They became obsolete, or let's say use the term useless. They were of no use. So by that, those machines became impaired. So in this question, or in this illustration, we are told the government has just imposed export quotas on the products manufactured by the plant. So it's like this plant is manufacturing certain products for export, but the government has introduced certain law restricting the export of the products manufactured by this particular plant. So how will you use this plant? It now becomes impaired. That's the point. You can refer to the external sources and internal sources of impairment as they are presented to you there, and you can understand what that point is all about. Then you are told the following this development, ABC Limited has prepared the following estimates of cash flows from the usage of the plant over the next 5 years. So the cash flows were presented, and these were the cash flows as they appear. So I'll return back there. The cash flows. See the cash flows there? Year 1, 2, 3, 4, 5. Those were the cash flows. The cash flows are there. Then what you do, for us, the first thing is to calculate the value in use. And you know how to calculate value in use. It is the present value of expected cash flows. Now here, the first illustration, I will use 15%. So this, you'll have year 1, 2, 3, 4, 5. Then cash flows will be given. This machine was expected to generate, these are millions. I've written 3 zeros there. So this is 2.3 million, these are millions. These figures are given. So the next thing that you do is to have a column for present value interest factors. How will I calculate this? You take 1 plus rate raised to negative n. Now I want to calculate for year 1 for you. You understand what we are, how did we get this one? So what you do, if you have to use your calculator, you just pick, so it's like 15% is the same as what? 15% is the same as 0.15 plus 1. Because you are saying 1 plus rate raised to negative n. Negative n is the number of years. For year 1, you raise by 1. For year 2, negative 2. Year 3, raised to negative 3. Year 4, raised by negative 4. Year 5, raised by negative 5. And then you get these numbers. Now let me try year 5. You can try the others. For year 5, I'll take, because this is 1 plus 0.15, that means 1.15 raised to negative 5. You raise by negative 5. You want to see for year 5. You get 0.4972. That's what you expect to get for year 5. Able to see that? Will you be able to see that? 1 point, because you'll be taking 1 plus 15%, which is same as 0.15, to be 1.15 raised to negative 5. You get 0.44971. So this number here. So the rest, you just be raising by the number of years. Make sure it is negative because you are calculating present values. So that is how you got this. So once you get this, multiply cash flows by present value interest factors, you get present values here. So just multiply column 1 by column 2, you get present values. Then add them together. If you sum them together, the total present values will give you value in use. Now, value in use, you can say that that figure is your recoverable amount. Because recoverable amount means compare the value in use with the net realizable value. So what is our net realizable value? What is our net realizable value? Now you have said this is how you get the net realizable value. Fair value minus selling cost. Selling cost. if you look at additional information number one, if you are to look at additional information number one, you are told that the plant could be sold currently for shillings 5.6 million. Selling costs would amount to shillings 100,000. So what is my net realizable value? Is 5.6 minus 100,000, which is 5.5. So the net realizable value will be 5.5. That is how I got here. My net realizable value, 5.5. So we should establish the recoverable amount by comparing value in use with fair or the net realizable value. You have said you take the higher. So we take 6,380,770. That is our recoverable amount. You are comparing these two. Then carrying amount. Remember we said for you to establish impairment, you compare carrying amount with recoverable amount. So I have my recoverable amount because I compared these two. I take the higher. Now, carrying amount have we been given? We have been told that ABC Limited owns a manufacturing plant with a carrying value of 7,490,000. That has been given. That has been given. Number one, ABC Limited owns a manufacturing plant with a carrying value of 7,490,000. That figure there. So that has been given directly. So I'll just come here and compare. This is my carrying amount. So I'm comparing these two. We have said that impairment occurs where carrying amount is more than recoverable amount. Is this asset impaired? Yes, it is impaired because carrying amount is 7,490,000 and the recoverable amount is 6,380,000. So carrying amount is more than recoverable. So what is my impairment? The difference, that is 7,490,000 minus 6,380,770, and my impairment is 1,109,290. So that is the impairment. So we are able to calculate our impairment. So it's quite simple, it's quite interesting, and easy to understand. So impairment, that is IAS 36, is always quite easy. We just need to understand how to calculate impairment, and then the other part, cash generating units. Cash generating units. So once you have known that, I have used 15% as my rate. Now I want to do the last illustration using 10.5% as my rate. I'll use the same approach, only that I will be using a different rate. So if I come to, so that is illustration 1. Now we come to illustration 2. Illustration 2. Let's do our illustration 2. So what I do is that I want to, let me see whether you should be able to see. You'll be able to see the entire illustration 2. Are you able to see that? Absolutely, you should be able to see that. Absolutely, you should be able to see our illustration 2. So we are using the same question, only that I want to use a different rate of 10.5%. I want to use 10.5%. For illustration 2, the same question that we are doing. The same question. If you have forgotten, you can just look at the question again. The cash flows remain the same. Then the first illustration, you can see we have used 15%. And now we want to do illustration 2, where our rate will be 10.5, 10.5%. Okay, that is what I'm saying. So what I do, because you have understood the concept, the cash flows are the same, the number of years are the same. We have year 1, 2, 3, 4, 5. Cash flows are the same here. What you do is have a column for present value, interest factor. So what you use, the only thing that you change is the present value interest factor, because here we are using 10.5%. So what will happen is that 10.5%, if you plus 1, you'll be 1 point, you'll be having 1.105 raised to negative n. Raised to negative n. Now you can try the first year. Now the first year will be 1.105 raised to negative 1. You get 0.90 or 0.9049. You can try that. You can try 1.105 raised to negative 1. The second one, you just take 1.105 raised to negative 2. The third one, 1.105 raised to negative 3. So it is only n which is changing to get the numbers in that particular column. So you can just do that. It's quite simple. Only negative n is changing. Just take 1.105 raised to negative 1, raised to negative 2, raised to negative 3, raised to negative 4, raised to negative 5. You get this present value, interest factors there, and then you multiply by cash flows. 2300 times 0.9050, you get these numbers here. These are the present values. We have said that if you total your present values, you get the value in use. Value in use, we have said, means the present value of all the expected cash flows. You can see this machine is expected to generate certain cash flows in the future. So what is the present value of those cash flows as at today for these 5 years? You have gotten 7,084,668. That's the value in use. If you sum up these present values for the 5 years, you get that. Then we compare with, now we need the net realizable value. That one did not change. I've told you it is the same illustration. We said in the previous illustration, the net realizable value was 5,500,000. Remember, we said that we were told that the plant could be sold currently for shillings 5.6. Selling cost was 100,000. So what is our net realizable value? 5.6 minus 100,000, which is 500,000. So that is how we got 500,000. Our net realizable value is just like for the previous one. Now the carrying amount is the same for the previous one. We were told that ABC Limited owns a manufacturing plant with a carrying value of 7,490,000, just like the previous one. Then recoverable amount, we compare value in use and the net realizable value. You take the higher. We want to see our recoverable amount, which is the higher, 7,084,668. We are comparing this one, the value in use, comparing with net realizable value. You take 7,084,668. So this is the recoverable amount. You compare with carrying amount of 7,490,000. So you are comparing these two. We said that impairment occurs where carrying amount is more than recoverable amount. So is there impairment here? Is there impairment? My carrying amount is 7,490,000. Or in other words, the net book value of this asset is 7,490,000. Recoverable amount is 7,084,000. So this carrying amount is more than recoverable amount. So there is impairment of how much? 7,490,000 minus 7,084,668, and you get an impairment of 405,332. So that is the impairment. So that is how we do our impairment. Now let me project that question back again to you, so that you can just try to go through it during your free time. The question was there. You just look at it. You can go through that question, that example. Remember that cash flows are given. They are always given. Those are the cash flows that the machine is expected to generate. The cash flows are there. Remember, the net book value or the carrying amount of the asset is 7,490,000. Then you are told the plant could be sold currently for 5.6. There are costs of 100,000. That helps us to get the net realizable value. 5.6 minus 100,000, which is 5,500,000. Cost of capital is 15%. Now, that number 2, I used 15% to do the first illustration. Then the second illustration, I used 10.5%. So I was just trying to illustrate how to calculate impairment, but I used 2 different rates. Illustration 1, remember I used 15%. For illustration 2, I used 10.5%. Then you are told to calculate recoverable amount and impairment. Remember, when impairment occurs. When does impairment occur? When does impairment occur? Impairment occurs when the carrying amount is more than the recoverable amount. And how do we establish recoverable amount? We compare the value in use and the net realizable value. The net realizable value. So I think you are able to see what is on the board. The first illustration, we are able to see the first illustration. We are able to see our the first illustration. We are able to see that. Well and good. We are able to see that. Well and good. Now the next thing that I want us to take together, I'll just do it from our book. Allow me to do it from our book, because I wanted us to complete this part today. I want to take cash generating units, cash generating assets. I can present that one to you, and then I move faster. This part, I think you can pause your video and then you can read our notes there. These are some of our research materials. Cash generating assets or units are the smallest group of assets for which independent cash flows can be identified and measured. As a rule, the recoverable amount of an asset should be calculated for the asset individually. However, there will be some instances whereby it will be impossible to estimate such an asset for an individual asset, particularly the value in use. If it is not possible to calculate the recoverable amount for an individual asset, the recoverable amount of that unit will be less than the carrying amount in the statement of the financial position for all the assets in the unit. An impairment loss should be recognized for a cash generating unit if the recoverable amount of that unit is less than the carrying amount in the statement of the financial position for all the assets in the unit. When an impairment loss is recognized, it should be allocated between the assets and the unit in the following order. Now that is very important now, the order that you follow. The first one, assets that are obviously impaired, e.g. damaged assets. Then number two, goodwill allocated to the cash generating unit. And number three, other assets on pro rata basis. So you go through those notes now from cash generating unit can thus refer to. So just pick from there, those notes. You just pause your video and you read what I have presented to you. And then after that, I may wish to illustrate an example. I may wish to illustrate two examples. I may wish to illustrate two examples. Now, there is an example there. You are told Faithful Limited is it legible in the first place. Faithful Limited has the following carrying amounts. Faithful Limited has the following carrying amounts in one of its divisions. You can see in goodwill, property, machines, motor vehicles, patents, then net monetary assets. Carrying amounts are given. Then after that, you are told, what are we told after that? Impairment review indicates recoverable of the unit at shilling 109 million. The selling price of the unit of assets are insignificant except property, which have a net realizable value of shillings 35 million, and the net monetary asset, which can be realized in full, required. Allocate the impairment loss to the individual assets. Now look at that solution there, because I'll take a different illustration for you. I'll take a different illustration for you for cash generating unit. But meanwhile, you can just take that illustration there, try to understand what we have tried to do there. Try to look at our allocation. So goodwill is always allocated in full. You can see the goodwill, the first item there, 13,000. Allocation, you have written full. Carrying amount, 13,000. Impairment, 13,000. Goodwill is fully impaired. That's what you should know when it comes to cash generating units. We always assume that goodwill is impaired in full. Goodwill is impaired in full. I think that is a point you should have noted there. Look again our illustration. Goodwill allocation, we have written full. Carrying amount, the 13,000 which is up there. That carrying amount is fully impaired. You can see there. Now go to the second item, property. Property, that 20,000, how have you treated that? Property, what are we being told? You have been told the selling price of the unit of assets are insignificant except property, which have a net realizable value of that 5 million and the net monetary assets which can be realized in full. So, allocation for the property, 0. No impairment, 0. Property, 0. For assets, you can see that. Property, nil. The carrying amount is 20 as given there. Property, 20. But you allocate 0 and then there is no impairment loss. No impairment loss. Now, net monetary, that point you have been told there, the selling price of the unit of assets are insignificant, except property, which have a net realizable value of shillings that 5 million, and the net monetary assets which can be realized in full. So you can see there, net monetary assets, allocation, nil, carrying amount, 19,000, impairment, nil. So for net monetary assets and property, impairment is nil. Now try to see what we have done with the others now. How we are allocating the others. Like, now the rest you use pro rata basis. The rest you use pro rata basis. The other you use pro rata basis. Now I'll show you the workings. Let me show you the workings before I take an example, a different example for you. So check. Impairment, we have said carrying amount minus recoverable amount, which is 150. Is 150 is there. The total carrying amount 150, you less 109, the one you find there. Impairment review indicates recoverable amount is 109. So you are taking 150 minus 109, which is 42. Allocation now. How do you go about allocation? You can see goodwill, 41 minus 13. 41 is a total impairment. Total impairment. Impairment loss, you can see it there. 41. You are minusing what? 13. You minus 13, which is a goodwill. Goodwill was fully impaired. You are left with 28. Now the rest you say you use pro rata basis. Now these others, because you say goodwill is fully impaired, property, there is no allocation, net monetary assets, no allocation, then impairment, you took 150 million minus 109, you are left with 42 million. You know goodwill, how you have gone about it? 41 minus, not 41 but 42. 42 minus 13. Machines, motor vehicles, and patents, you use pro rata basis. You use pro rata basis. I present that again. See what you have done. See what you have done. Machines, you're using pro rata basis. 49, 35, 49, 35. The 45, 39, those numbers are the carrying amounts. See the carrying amounts there. If it is machines, why are you using 49? Because it is a carrying amount. Over, why are we dividing by 98? 98 is coming from 49 plus 35 plus 14. Because you have machines, motor vehicles, and patents. Because for goodwill, you have allocated in full. Property, nil. Net monetary assets, nil. So you are left with machines, motor vehicles, and patents. So just sum up 49 plus 35 plus 15 to get 98. So if it is machines, If it is machines, you take 49, which is that 49, you can see there, carrying amount 49 over 98. Where's 98 coming from? 49 plus 35 plus 14 times 28. 28 is a goodwill. 41, I think it was 42 minus 13 or something like that. Then patterns and all that. So you got 14, 10 and all that. So you sum them together. And then finally, you have something like that. Goodwill, impairment, and then impaired value. Are you able to see that? You able to see our conclusion? Our conclusion is there. Our conclusion is there. Our conclusion is there. So it started on the other side. Just make a follow-up. We are told Faithful Limited has the following carrying amounts in one of its divisions. So you start following from there. You are given carrying amount for different items: property, goodwill, property, machines, motor vehicles, patents, net monetary assets. You are given the totals there. And then you are told impairment review indicates recoverable amount of the unit at shillings 109. So if you compare 150, remember 150 is the total carrying amount, compare with recoverable amount of 109, and you have said impairment occurs when carrying amount is more than recoverable amount. So if the carrying amount is 150 million and recoverable amount is 109 million, then that asset has been impaired. Now, impaired by how much? Now, the next thing you have been told is the selling price of the unit of the assets are insignificant, so you have done that. So just make a follow-up of our solution down there. You follow that solution there. I have explained to you. Make a follow-up all the way up to the other page where we have done our conclusion. Where we have done our conclusion. I think that should be enough for impairment. That should be enough for impairment. However, let me promise that I'll take one more lesson for impairment, especially cash generating unit. I've just presented a worked out example for cash generating unit by the end of this discussion here. That one I have not done it here, but I just want to show you in advance so that next lesson I'll show it on the board as I show the calculations for you so that you may understand in a better way. So meanwhile, you can look at that example for cash generating unit from what I have presented to you. And the next lesson, I'll show you a calculation for cash generating unit. So note that our focus for impairment of assets, that is IAS 16 for today, was to show you how to establish whether an asset is impaired. And you have said that an asset is said to be impaired if the carrying amount is more than the recoverable amount. We know impairment is the same as depreciation. So, if you take the cost of an asset and you minus the accumulated depreciation, you get the net book value, which is also known as the carrying amount. So that carrying amount you compare with the recoverable amount. And how do we calculate the recoverable amount? Two items should be compared. One, value in use. The value in use means the present value of all the expected cash flows. You should be able to use your tables this way, be able to calculate the present value interest factor, just simple 1 plus r into brackets raised to negative n. N is the number of years. Then you multiply by the cash flows. You have your present values. Sum them together to get the value in use. Now, once you get the value in use, remember to calculate the other figure known as the fair value or the net realizable value. Net realizable value means you'll be taking fair value, that is, this asset can be sold at how much in the market. That amount at which this asset can be sold at, you minus any cost incurred. Selling price minus any cost incurred, you get the net realizable value. So you compare the value in use and the net realizable value. You take the higher. So that one figure is the one known as a recoverable amount. Compare with the carrying amount. If the carrying amount is more than the recoverable amount, then that asset is said to be impaired. If it is the other way around, if the carrying amount is less than the recoverable amount, then that asset is not impaired. That's as simple as that. So just comparing the carrying amount with the recoverable amount. And then the difference represents impairment. So I think we have shown that one extensively. And the next presentation, even though I have introduced that part to you briefly, maybe you may not have understood what I have presented to you in my book, but I'll take one more illustration with workings. So meanwhile, try to understand how impairment occurs and how we calculate these figures. So for details, I'll just give you that. The code is, this is the code for Kenya plus 254. We are following from other countries and you may need to communicate. You start with plus 254, 727, 87, 10, 93. Those who are within the country, 0727, the same number, 0727, 87, 10, 93. So we also remind you that we are finalizing chapter 1 on advanced financial reporting, and we are concluding next lesson. This is all about impairment. So you discuss financial assets and financial liabilities tomorrow, and then we move to chapter 2, which is about the group. Very important in financial reporting as well as advanced financial reporting. So make sure you subscribe, you like our video, you make a comment, so that from next week now, you'll be getting updates concerning group accounts. Now let's move together so that you don't get maybe lost somewhere by saying that I did not have this particular chapter or this particular topic or subtopic. So once you subscribe, you'll be just getting these updates maybe every day, 2 lessons or 1 lesson or 3 lessons every day. So that by the end of this month, you'll have concluded our discussions. The next month, we start with revisions, because the examinations, that is the Kenya Accountants and Secretaries National Examination Board, starts the first month of December. So you have to prepare in advance, and then we start revising in advance, because we don't want you to fail in this examination. So that's all for today. I think that's great. If you do not understand any concept, just feel free to communicate. You clarify your questions. Other lessons are still ongoing. For advanced financial management, advanced auditing, advanced taxation, advanced management accounting, CPA foundation level, intermediate level, ATB, CFA, that is Certified Investments and Financial Analysis. All these subjects are ongoing. So feel free to call us for any assistance. We will help you as much as we can. So let's meet the next lesson. So I've promised you that I will upload or I'll take for you a cash generating unit question, because the one that I have presented to you, I have not illustrated in details, but at least you have a clue, you have an idea about cash generating units. So that is the next lesson that I'll present to you. So once you view this one, you understand it, just go to the next video and you take cash generating unit. I think that's enough for today.